And 3, 2, 1. Welcome to the show. We are obviously remote today.
We're going to be remote for a few weeks. I'm up at my parents' place in an undisclosed location on the outside of Boston, Massachusetts, and be up here for a few weeks. So it's a good place to be in July.
Lucky you.
A lot of
You,
stuff
you
going
guys
on
will
in the
see
market
that
this week, my friend.
there's a little bit of a delay the way we're doing this, kind of like they have on TV. If you ever you guys watch like the Today Show or something or whatever, when they have a remote person, there's a little bit of a delay from when Jerry hears me. So if you guys see us talk over each other, we apologize. It's always something.
We'll get the hang of it, but let's launch into it because this is a pretty good show this week. There's a lot going on. So TSP Weekly Podcast, 16 July 2023. So we're going to look at CPI and PPI, is Consumer Price Index, and Producer Price Index. Both of them came out this week. One CPI was Wednesday, PPI was Thursday, and they are the Fed's preferred inflation measures. The next thing is the dollar versus the I-fund. We've been talking about that quite a bit, both on the show and in the newsletters. I think we talked about on the show last week that you definitely wanted to read that piece on the dollar versus the I-fund this week, and because the setup in the dollar last week gave us a very clear indication that the I-fund was going to pop this week, and that's what happened. And then, so we're going to take a look at that in different ways. You can look at the charts of the dollar and the I-fund. Then this one, I don't know if it's on everybody's radar. Maybe some folks have heard about it, but the Brics countries are doing a big meeting on August 22nd, and we'll talk through a couple of articles about that. They're creating a new currency that's going to challenge the dollar, and so we'll talk about that a little bit. And then bonus chart is going to be gold, which relates back to this Brics issue that's going on right now. And then we'll take a look at the TSP weekly fund charts. All right. So I got this from this Wall Street Journal article right here, and the title of the article was "Inflation Eased." So this is Wednesday. Inflation eased to 3% in June, slowest pace in more than 2 years. Fed officials are still likely to raise interest rates when they meet later this month. So, I should know this off the top of my head. It's something like July 24th, 5th, 6th in there is the next FOMC meeting. So we're very likely to get another 0.25% rate hike. But inflation cooled last month to its slowest pace in more than 2 years, giving Americans relief from a painful period of rising prices and boosting the chances that the Federal Reserve will stop raising interest rates after an expected increase this month in July. CPI climbed 3% in June from a year earlier. Labor Department said on Wednesday, sharply lower than the recent inflation peak of 9.1% back in June of last summer. And that's when gas prices hit a U.S. record average of $5 a gallon. The June rate declined from 4% in May, right? Inflation was last close to 3% in March of 2021. So we're definitely moving in the right direction. But just so everybody kind of remembers, inflation means prices are going up. A decrease in inflation means prices are going up, just not as fast as they were last month. So it's not deflation, which is when prices come down. It's just disinflation, meaning it's rising slower than it was last month, but prices are still going up. Okay, so that's CPI. Producer Price Index, U.S. wholesale inflation. This was a MarketWatch article. U.S. wholesale inflation slows to a crawl. PPI shows Producer Price Index has risen just 0.1% in the past 12 months. So PPI report captures what companies pay for supplies, such as fuel, packing gear, and all that. These costs are often passed on to customers at the retail level and give an idea of whether inflation is rising or falling. So in the big picture, wholesale prices have slowed even faster this year than consumer prices. Perhaps a sign that inflation will retreat faster than the Fed expected, which is what everybody wants, because as inflation comes down, it increases the odds that the Fed will stop raising rates, because raising rates is fighting inflation. And so if inflation continues to fall, they don't need to continue to fight it. Yet it's going to take several more months of weak inflation readings, at the very least, according to this article, to persuade the central bank its job is largely done. Fed manages inflation by raising interest rates and slowing the economy. But the problem with raising interest rates and slowing the economy is the chief risk, which is a recession. So the higher rates go, the more likely that higher borrowing costs trigger a recession. So good news, basically, on the CPI and PPI front, but we do have this, overhang here, and it's one of the things we're going to talk about on in the newsletter this weekend. Is I'm actually doing a chart of the St. Louis Fed has a website, and they show, people talk about the twos, tens bond yields. We've done it a couple times on the show. When you subtract the 2-year yield from the 10-year yield, if it's inverted, they talk about the inverted yield curve. The curve has been inverted for months, and it's just starting to turn back up the other way, which is arguably, according to one of the articles I'm going to post about, is a positive. But we'll see in the chart over time that recession actually comes when the difference between the tens and twos uninvert, so it becomes actually positive. So it's still inverted, it's still negative, and so that means we probably still have some time until a recession hits, which, if you kind of pull that into this idea, it gives the Fed more time to continue to raise rates. So it's going to be an interesting next few months to see how this all kind of merges together. Right. So the dollar and the I fund. You guys might be sick of hearing me talk about this, but it's so easy right now to trade the I fund. This is a chart of the dollar. Okay, so each tick is 1 day of price movement. This is the 20-day moving average line, relative strength indicator, and MACD. So if you just look at the pattern, right? This is we had a big decline in the price of the dollar. Then we have an A, B, C, D, E sort of triangle consolidation pattern, and then a breakdown. And once we got below this lower channel line, theoretically, price comes down the same distance as this. Okay, so we had a really clear breakout. This was on July 13th. It was Wednesday. So Tuesday we had a breakdown through it, but on Wednesday we had a substantial breakdown through it. RSI way oversold, right? MACD crossing big time to the downside. So there's a lot of momentum to the downside in the dollar right now. And when the dollar goes down, the I fund goes up. So if you're just looking at the chart of the dollar, this is really good. You can also trade, there's a ticker symbol called UDN, or UUP is when the dollar is going up, and UDN is when the dollar is going down. So you can actually trade those as an ETF if you wanted to. So the I fund chart isn't as telling as you look at it on its own. Where the dollar, we broke these lows, right? On the I fund, we haven't broken the highs yet. Okay, this is as of the 13th. We got a big gap up. We had a buy trigger, right? We got a gap up through that 20-day moving average line. We got above 50 RSI, and MACD had crossed positive. So we did get a buy trigger for the I fund. It just isn't as clear as the dollar is right now, which basically means that the I fund is going to clear all this resistance because we know the dollar already did. So that's if you're looking at the two individual charts. The best way to do it are the next two charts. So in this one, I just put the I fund on top and the dollar on the bottom, right? So each of them are 1 day of price movement. And you can see when the dollar goes up, the I fund goes down, right? When the dollar tops, the I fund bottoms. It's clear as can be. I mean, it's very, very close to 100% inverse correlation. It's not 100% because we got the dollar breaking through support here, and the I fund hasn't quite gotten above resistance yet there. But this should be telling you that the next move is up in the I fund. Okay. And my favorite way to look at it is actually this. So there's a whole bunch of different things you can do in TradingView. You could also do it in stock charts, but this is one chart overlaid on top of the other. So this is the dollar, in orange is the I fund, and it's really easy to see when the dollar goes up, the I fund goes down, dollar goes down, I fund goes up, dollar goes up, I fund goes down. I mean, it's and then you have something like this, a giant move down in the dollar and not so much of a big move up yet in the I fund. But we got what's really important to me is this low and this 1, 2, 3, but a whole bunch of support here, and we got below it, and it's the same thing. So this is the scale for the dollar, and this is the price scale for the I fund. So the I fund has been bumping up against that 74 level right here for a couple of months, and this is telling you that the I fund is going to get above that 74 level. Okay. All right. So August 22nd. This one is from a Fortune magazine article from the end of June. If you Google Brics meeting, anything like that, Brics Nations meeting, you'll get very little in the American press about this. I had to go a couple pages into Google to find this Fortune article, but it's all over the rest of the world. So it's definitely worth Googling and looking at a couple of those different articles. You can look at this one in Fortune, but I pulled out the important pieces from it. So I'm just going to kind of talk through it kind of quick. How long will the dollar last as the world's default currency? Right. That's the question that's on everybody's mind in this macroeconomic conditions. So the Brics nations, Brics is Brazil, Russia, India, China, and South Africa. And now they call it Brics Plus because there are a bunch more nations that are joining this Brics group. So the Brics nations are gathering in South Africa this August with the question of how long will the dollar last as the default currency is the agenda. So South Africa is going to host the Brics countries. Among the agenda item is the creation of a new Brics currency. A scholar who has studied the Brics countries over a decade, I can certainly see why the talk of a Brics currency is, well, gaining currency. The Brics Summit comes as countries across the world are confronting a changing geopolitical landscape that is challenging the traditional dominance of the West. And while the Brics countries have been seeking to reduce their reliance on the dollar for over a decade, Western sanctions on Russia after its invasion of Ukraine have accelerated the process. That was a very big deal when the sanctions were one thing. We've done that for a long time in different countries. The bigger piece, and I think they talk about it in here, is kicking Russia out of the SWIFT system. So meanwhile, rising interest rates and the recent debt ceiling crisis in the US have raised concerns among other countries about their dollar-denominated debt and the demise of the dollar should the world's leading economy ever default, right? With 88% of international transactions conducted in dollars and the dollar accounting for 58% of global foreign exchange reserves, the dollar's global dominance is indisputable. Yet, de-dollarization, or reducing an economy's reliance on the dollar for international trade and finance, has been accelerating following that Russian invasion. So Brics countries have been pursuing a wide range of initiatives to decrease their dependence on the dollar. Over the past year, Russia, China, and Brazil have turned to greater use of non-dollar currencies in their cross-border transactions. And then you add to that Iraq, Saudi Arabia, UAE, they're all exploring new alternatives to the dollar. Central banks have sought to shift more of their currency reserves away from the dollar and into gold. All the Brics nations have been critical of the dollar's dominance for different reasons. Russian officials have been championing de-dollarization due to the to ease the pain from sanctions. Because of sanctions, Russian banks have been unable to use SWIFT, which is the global messaging system that enables bank transactions. So when we kicked Russia off of the SWIFT system, it was a very, very big deal. We froze 330 billion in reserves last year. I mean, we do those kinds of things, but kicking them off of the SWIFT system made it impossible for them to trade in dollars with the rest of the world. And so that was kind of the straw that broke the camel's back. And now they're all getting together to create a new system that they don't have to use dollars. Building blocks for this already exist. In 2010, Brics, they started up this Brics Bank, was launched to facilitate cross-border payments between Brics banks and local currencies. Brics nations have been developing Brics Pay, there's a lot going on, right? If they start not just buying and selling oil and what I'm trying to say, oil, currencies, commodities, if it comes down to local transactions, it really changes everything. There's talk of a BRICS cryptocurrency and of strategically aligning the development of the central bank digital currency to promote currency interoperability and economic integration. So they're talking about all the things that the SWIFT system has, and basically the system that the West uses to transact, and it's clearly going to be a competitor to the dollar. It's not going to happen tomorrow, but it's definitely in the process. The group is likely to scale its de-dollarization agenda. So this August 22nd meeting is going to be a very big deal. The one thing they don't talk about in that article, but I have seen on some other videos, apparently originally the idea was that the BRICS currency was going to be based on a basket of commodities. And now it appears that they've pulled back from that, and it's going to be, I don't know, a gold standard per se, but it's going to be linked to gold somehow rather than a basket of commodities, is the latest that is my understanding. But definitely something you want to have on your radar, and it'll be worth watching on August 22nd to see what they come out with.
It's pretty interesting that we don't hear a lot about that in the mainstream media here, you know.
If you Google it, it takes a couple pages before you see any U.S. media covering it at all in Google. Yeah, it's unfortunate because it's the biggest thing on the macroeconomic stage in the world right now. So the reason I did gold as the bonus chart is because when that article came out, among some others, as you would expect, gold popped. So here's a long-term chart going back to gold in 2007. Each tick is a week of price movement. And we have this thing, it's called a cup and a handle. So here's the left side of the cup. Here's the cup. We got an ABC correction for the handle. And theoretically, once we get above about let's say 195, we get above this lip of the cup. And if you really want to be conservative about it, you get above these highs, the dollar goes higher. Okay, that's how the pattern works. So if you were to buy into the dollar here, you'd be expecting a run up to challenge these highs, which is a pretty decent percentage move higher, and then maybe some churning there, and then a bump higher. So it's less risky if you buy it above that like 195 level, because then you've cleared all this historical resistance. But I would definitely keep gold on the radar. So that's the long-term view of it. If you zoom into the short term, this is what's been happening since this. The talk of all the stuff with Brics has been going on for a while, but in the last 2 weeks, and then particularly on the 13th, I think it is, 13th, big gap up in gold, and you can kind of see what happens. Gold it goes in kind of long, like trends. So we got a downtrend, consolidation, a downtrend, consolidation, downtrend. It's the same thing on the upside. So you get a pretty big move on the upside. A gap down, comes down. When it gaps up, you're going to have some time to the upside. So I actually bought gold on that day because of that gap up. Okay, last up is the TSP fund charts for the week. So I go back to right before COVID. So here's the COVID low. Each one of these ticks is 1 week of price movement. The blue line is the 20-week moving average line, the relative strength indicator, and the MACD indicator. Okay. So if you are managing your TSP on a weekly basis, right, you can see that once, we had about a 27% drawdown during COVID in the C fund. But once we got back above that 20-week moving average line, every time we came down to it, we got support there, right? Until we collapsed through it at the top in January 2022. And along with that is the first time we get above that 20-week moving average line, we're now above 50 on relative strength, and MACD crosses to the upside. Okay, so you could have gotten back into the market, say on this big up week, but the risk of it coming up, hitting resistance, and rolling back over is much higher than if it got above that line. And so that's why we use moving average lines as part of the stack. So so here we are. So this is coming off of a 27% pullback, right? It's not all that different from this pullback that we had in 2022. So if we look at it and say, okay, we had a pretty good bull market after that 27% correction. Are we going to have another pretty good bull market off of this 20%, 25% correction? So we are now above, as of really, this week, but we're certainly above that 20-week moving average line now, right? And more important to me, actually, is that we have cleared this. Here's the 50 line in RSI. And as long as we're up in this upper band of RSI, we're good. And MACD is positive, we're good. We're going to get some, down weeks because the market doesn't go up in a straight line. But as long as RSI stays in this upper section, we're in good shape. And as long as MACD is green, we're good. Okay. Clearly, the next big hurdle is going to be 4,800 up here. And it's going to be interesting to see what happens when we get there. So that's the C fund. S fund. This is a very similar looking chart to the dollar that we looked at. And like we said, in the dollar, we had a move down. In the dollar, it was A, B, C, D, E, and came down. And theoretically, it was going to be like this, right? What's interesting is that when the dollar goes down, the I fund goes up. There's almost 100% correlation there. When the dollar goes down, it's good for the stock funds in general. So to have the pattern be the same on the dollar and the S fund, one of them was going to be wrong, right? One of them has to be wrong because the dollar can't do this and the S fund do this, right? It can't work that way, which is why, you look at the pattern until it fails. And basically, this is a failed pattern. The S fund was going up as the dollar is going down. So the S fund's breaking out to the upside as the dollar is breaking down to the downside. So this is a great time. Well, this is a low risk time to get into the S fund, right? Because if it rolls over here, you just get back out because then it hasn't, the pattern is still going. But if it keeps going, give it maybe one more week. If it keeps going and it clears all this, definitely if it clears 1850, S funds are moving higher. And RSI looks really good. And MACD crossed positive. Okay. I fund we talked about, and by the 14th, because we had the chart up from the 13th, right? By the 14th, yes, we cleared that 74 level, right? Ton of support here at that 20-week moving average line and a big move up this week. And we cleared that 74 support resistance level. And we got really good support at 50 RSI. We don't yet have MACD turning positive, but I think by the end of the day, probably on Friday, we're going to have that. If not, we'll certainly have it early next week. So despite, there's still a whole lot of pressure. The Fed's going to continue to raise rates. There's a lot of macroeconomic problems in the world, but the stock market's moving higher until it doesn't. F fund had a really strong week, which I thought is interesting. If we're going back into this environment where stocks and bonds move in the same direction, it's going to be pretty interesting. So I still think the next leg in the F fund is down. We've been talking about this here for a while. This is the top in the F fund. You got 1, 2, 3, 4, and we should have one more move down on the F fund. We had a really big down move last week, big up move this week, but
All right, guys. Well, we lost Jerry there right at the end. I guess the power went out at his house. I guess they're doing construction next door or something. The good thing is he was actually done there with the F fund. So as usual, if you have any questions at all, please put them in the comment section wherever you find this video. If you don't have a comment section wherever you found the video, then feel free to shoot us an email at support@growmytsp.com. The support team will get it to us, and we will do our best to answer it. Sorry for the abrupt ending there, but we did get the important part out. All right. Hope you guys have a great week, and we will see you later.